ultimately our country could experience a long and painful recession. We must not let this happen.
Now, in predicting when and how the collapse would occur, my focus was again on the actions of our government.
Michael James Burry, the man who predicted the 2008 crash while the rest of Wall Street was drunk on profits, has just shut down his hedge fund and returned every investor dollar. Not because he's retiring, but because he believes the market has become so distorted, so irrational, that his entire way of valuing companies no longer works. His exact words were, "My estimation of value in securities is not in sync with the markets." That's not a casual statement. That's a red flag from one of the sharpest minds in finance. So what does it actually mean? And more importantly, why should you care? Because the distortion he's talking about isn't crypto, and it isn't housing market. It's AI. A trillion-dollar boom that now carries the entire financial market on its back. Burry didn't come from Wall Street royalty. He built Scion Capital alone. One man, a computer, and an obsession with tearing apart financial statements. No hype, no connections, just pure analysis. And that discipline led him to the biggest bet of his life. While everyone else celebrated the housing boom, Burry saw subprime loans turning toxic and bet against the entire system. They called him insane, until 2008 proved him right. He made over $100 million personally, shut down Scion to escape the circus, came back years later. And now, in 2025, he's pulled the plug again. But this time, he might not return to Wall Street at all. A leaked investor letter, dated October 27th, explained why. Burry wasn't blaming the economy or volatility, he was blaming the market itself. And the numbers behind his frustration are massive. The real reason he walked away is simple. Tech and AI companies are engineering profits with accounting tricks. For months, Burry has been calling out giants like Meta, Microsoft, Alphabet, and Oracle for using stretched depreciation schedules to inflate earnings. He estimates that between 2026 and 2028, these companies will hide nearly $176 billion in real hardware costs, not through innovation, but through accounting. Think of AI like a giant factory made of computers. These servers work day and night, processing massive amounts of data. Because of that nonstop stress, most of these machines wear out in just 2 to 3 years. In the real world, they break down fast. But on the company's books, those same machines are treated like they last 5 or 6 years. Why do that? Because a longer lifespan means lower depreciation expense. And lower expenses mean artificially higher profits. And we're already seeing the effect. Take Amazon. In 2024, AWS extended the life of its servers by 1 year and immediately added $900 million to operating income without generating a single dollar of new business. Look at Alphabet. In 2023, Google pushed server life to 6 years, saving $3.9 billion in depreciation and boosting net income by roughly $3 billion. Even Palantir's filings show depreciation rising from $19.5 million in 2022 to $23.7 million in 2024. Proving how sensitive these numbers are to accounting assumptions, analysts warn that if companies like Meta were forced to use realistic hardware lifespans, their operating income could fall by $5 billion. The hardware isn't lasting longer. The accounting is doing the heavy lifting. Across the AI sector, these adjustments will quietly cover up $176 billion in actual costs over the next 3 years. That isn't innovation. That's earnings manufactured in a spreadsheet. And yet the market behaves as if AI is risk-free, growth infinite, and competition-proof. Burry went the opposite direction. He spent $9.2 million buying 50,000 put options on Palantir, the right to sell the stock at $50 in 2027, even though it was trading at $178 with a $422 billion market cap. He took similar bearish positions against Nvidia, the centerpiece of the entire AI rally. While AI stocks have driven 75% of the S&P 500's total gains since 2022, Burry bet that those gains were built on hype, momentum, and accounting illusions, not real earnings. Burry isn't warning that stocks are overvalued. He's diagnosing something far worse. The mechanism that used to price value is gone. This isn't a temporary bubble. It's a structural flaw. A market where fundamentals barely register and passive flows overpower every form of real analysis. This is the real villain in today's financial system. A market that has stopped thinking and started following. The part no one wants to admit is this: the market isn't being priced by humans anymore. Analysis isn't driving valuations. Cash flow isn't driving valuations. Reality isn't driving valuations. Today, the force moving prices is far simpler and far more dangerous. Flows, index funds that buy everything in a basket. Volatility targeting algorithms that adjust positions automatically. Trend following quant models that chase whatever moved last. Bots that buy just because the previous tick was green. Money isn't choosing companies anymore. It's flooding categories. And when money floods a category, prices rise simply because prices are rising. Demand follows demand. Momentum becomes truth. Narrative becomes valuation. This is the machine that now runs the market. A machine chasing its own shadow. Burry didn't shut down Scion because he's scared. He shut it down because the market he built his career on no longer exists. When momentum replaces valuation, three things become system-wide threats. One crack in the AI narrative, one ugly earnings miss one liquidity shock, and because trillions are tied to categories, not companies, the exit becomes synchronized. Passive flows amplify the highs and multiply the drop. This is what Burry sees: a market where stories inflate prices, and accounting keeps the illusion alive just long enough for everyone to believe it. Burry isn't predicting doom. He's pointing out the truth everyone's ignoring. Prices and reality no longer line up. When the smartest contrarian walks away because accuracy doesn't matter anymore, you pay attention. Danger doesn't always come as fraud. Sometimes it's the moment a market turns into a machine. This is Michael Burry's final warning. And in the end, it's all part of the money game. Like this video and subscribe, and I'll show you what Wall Street never wants you to see.